we'll figure it out.
Hey guys, super happy to be here once again. And today I'm very excited because Mark is here, and Mark is a very friendly guy with a very interesting story that we're going to be speaking about his story and his journey today. And the relation to the quantitative industry obviously is going to be the top of the conversation. And without me going further into details. Mark, it's a pleasure to have you here. I'm very glad for the opportunity. And before we dive deep into the details, I would love if you can present yourself to the audience.
Sure, thank you. Yeah, it's great to have this. This is my first actually podcast interview. Probably as
Great to be your first.
yeah, cheers. Um, so yeah, we do a couple of things, but we are mainly active in the cryptocurrency space, digital asset space. We are running cross-sectional quantitative alpha factors that are kind of crypto native and capture the kind of idiosyncratic alpha and idiosyncratic data that is available in crypto. We trade that. We serve it to others as well. We serve the base factors that you can, yeah, see on our site that some can subscribe to through an API. Imagine like if you had MSCI or BARA, but for crypto and really focusing on alpha. And we also run separately managed accounts with a joint venture with our friends.
Very interesting. MSCI or BARA models for cryptocurrencies. Let's explore that topic a bit. What do you mean? How do you can craft like a BARA equation or the foundation of it to cryptocurrencies? That makes me very interesting.
Yeah, so just to be, like very upfront, what we are really focusing on is the is constructing and creating and capturing alpha factors rather than more academic risk type factors. There are a couple of providers, I think Tyco, and et cetera, that I can't recall right now, that are doing the more academic factors like size, value, growth, I don't know, a couple of the typical ones that you get in US equities. They reconstruct that for crypto, and then you can measure, yeah, like their average returns over certain periods, how they have performed. You can make inferences based on, like what would that tell you about the current state of the market. We do more all of this with this focus on producing, yeah, superior CAGR and risk-adjusted returns. And we do have a very specific field within that, which is market microstructure, and also just generally all of the derivative metrics that are some of them are uniquely available in crypto, and yes, some of them are, just the standard ones that you could also use in US equities. This is where we have found alpha, and these are the stuff that we are creating cross-sectional alpha factors of in a, like very much usual way, right?
Mhm.
Um, and we surface those, um, and yeah, like serve it to others and trade it ourselves.
Mhm.
Maybe I can go into more into depth, but yeah, please
Yeah,
rather
no,
ask.
obviously, very interesting topic. There are multiple way to generate alpha, and I think that that's a very unique one, in the sense that you are looking for current returns, and based on the current returns, you're actually locating alpha. I would love if you can, go more in depth in the
Mm,
process and how do you actually craft it. Like, what was the incentive or the rationale, like going to that path to do some alpha research, and I would love to understand what are the notes that you have been taking like while going on doing your alpha research in that path.
yeah. Sure. So I think originally we started as a very small prop trading firm. I sold my first company 5 years ago, and I really wanted.
Congratulations.
Yeah, thanks.
We're going to be speaking about it again. We're going to be speaking about it as well in a conversation. So, yeah.
Yeah, cheers. So yeah, it was. I had this weird idea that I really wanted to manage the proceeds with quantitative methods. To be honest, looking back to it, I think that was not like a very naive kind of thing, but I thought that that's what I meant to do, and I will like what I am uniquely like set out to do with my mindset. And I really wanted to some kind of like hook onto some kind of certainty, because like the like investment world is, as you are very familiar with it, like is very diverse, and yeah, sometimes you can hurt yourself, or get hurt, right? With if
Mhm.
you're doing it very naively. And I really wanted to find this certainty with the quantitative methods. Anyway, this that's like a short bit. And then, okay, so we have gone into crypto because, to be honest, we have seen some of our friends who we ended up partnering with um, being successful, and we kind of dropped it because what we were doing had, I think, a lot less potential. And we went into crypto um, with the same approach that we have previously developed. So how we create, or how we kind of research alpha factors, is that we try to get our hands on all of the data that is available. We create our own queries on top of them. So we get order book, trades, um, quotes, derivative metrics that are
Everything,
available.
everything that you
Everything
can
that we
just think of.
Yes, and also at the same time trying to create a couple of hypotheses around like how these can be usefully aggregated into something that is predictable over a longer time horizon, right? So when we talk about cross-sectional factors, they are measured in days, meaning their rebalancing period is in days, as anything else would probably generate too much turnover and would kill the alpha. So when we are talking about, so we are creating these aggregates, so um, that are really trying to describe for example, where retail is positioned versus the other group. That is, let's say, on the market makers slash institutional side, we create
And
different.
that's a very challenging mission by itself, like to map the data. Now you have received the data, you have received multiple layers of the data, very heterogeneous amount of data. And right now to map like retail intervenience in the market, in comparison to the market makers is very challenging. And I was speaking about it, like I was speaking about like AMMs, automatic market makers on a previous recording session that I had. I told the guest that it's very interesting how the market makers like tirelessly shifted towards towards cryptocurrencies, because now you have different adjustments and modifications that you would need to install in the current application, because the market is very challenging and very adaptive. So I'd like to ask you, how can you think of mapping retail inconvenience, like from market makers, and how do you see the data after receiving a bunch of it?
Yeah, so we mostly focus on derivatives data, so like the perpetual
Ah,
futures market, which is
that
like very
makes sense.
much driving the volume and the open interest on the crypto side. Although, to be honest, we also look at spot and the differences, and like unusual ratios of activities between perps and spot, which can be useful in certain cases. Um, but yeah, I mean, retail is mostly depending on, yeah, like in terms of volume, there will be more active on perps. It's kind of designed for them, right? As well. And and yeah, like we try to come up with a bunch of these classification scenarios, and then of how would we define, or how would we recognize a trade that has happened, and how would we, like give a probability to it, so that it being retail versus non-retail. In crypto, it's a tiny bit easier because at least you get one flip that tells you whether the trade has been, or the buy has been on the aggressor side or on the sell side. So you can, so what did the market order was originally attributed to, whether it's a sell or a buy. And I guess you can, usually infer that yeah, most of the time yeah, institutionals will be either using at least some kind of TWAP, BWAP type algorithm, but are also trying to be more on the taker side slash more maker side.
Yeah,
What's
well, obviously the distribution of orders in the book itself is using TWAP, BWAP, like as a native algorithm, as a native choice of an algorithm to distribute the orders all around the book. But
yeah,
I would stop and I would wonder
sure.
for a minute if the well I to be frank I haven't really researched heavily about like how the derivatives in crypto are actually being traded from from the institutional side. So I would love to receive your point of it, because I think that it's a thing that we haven't really touched in the podcast until that point. So I would like to hear what do you think about like the distribution of of market makers, and how do you see them intervening in the book, and how the fingerprints are actually being very similar to what we know in traditional assets classes.
Yeah, um, you know, um, I can try to yeah talk a little bit about it. Let me gather my thoughts. So. Um, I think many of the usual things apply in crypto, although the order book and the codes that are submitted are, yeah, in certain cases, there's a lot of spoofing going on, a lot of liquidity disappearing from the order book. Then, time comes. So. I do not have any strong opinion on that. I think it's measurably different, or like qualitatively different if you like try to trade crypto versus yeah US equities futures, right? Of course, like there is an order of magnitude of difference in terms of open interest and volume, but crypto is extremely, or can be extremely liquid, even during the weekends. Yeah, I was trying to yeah, there are some stories about that that I could yeah I could tell, but it's it's not great. I let me think about like there are definitely the same things are happening that would be happening in US equities, or like US equities futures. Like at a certain shock event, the market makers usually disappear, and yeah, liquidity and the yeah orders are falling through the order book, right? And there is like a huge price movements. Sometimes they don't come back for hours, and that creates an interesting dynamic and potentially opportunities. The spread is really wide, and yeah, you can, yes,
I just think about like the complexity that suddenly, even on weekends, you have some extreme liquidity points and extreme intervenience in the market. And and that apparently makes the data much more complex. And if we know how to clean the data, like in a manner sense of like future data for the NQ or for the ES data, and we know how to clean it properly, like in crypto, it's a complete different landscape. And that landscape gets much more complex, not just because you have weekend trading available, but you still have like that market seems to have no rules in terms of how to clean the data, how to organize the data, how to think of the data, how to even locate it, uh, you know um, some fractions or some nominalism data, that would be complete different, a complete different challenge than what we know nowadays. And that really relates to the question that I have asked you before about like the inconvenience of market makers and how you can spot them in derivative trading in cryptocurrencies. And my point is that although it gets really, really challenging and really hard to do, the explorational phase gets to be much more interesting in a manner that you don't really know how to clean up your data, and thus your entire model selection gets completely changed. And it makes everything much more like it's a complete another field. And I would like to deepen that conversation with a question for you, saying that, okay, now assuming that you have cleaned the data, how would you know how to derive it to your own needs in terms of, like we have discussed about barrel or MSC or MSCI models, and how do you craft them in orchestrating them towards your need after cleaning the data?
Yeah, sure. Then after we have cleaned the data, we gone through like a step of at least cleaning the raw data, that coming up with hypotheses, creating a really wide range of metrics, from the usual traditional, market microstructure metrics that we can aggregate onto a longer time frame and longer interval. That some of those are still predictive and potentially quite predictive, to entirely new ones that we brainstormed out of, I don't know, like our observations of the crypto market. And then we run IC checks. We check for their predictive power in the cross section. And we usually, what we do differently to others, is that we concentrate really on a tradable universe. So yeah, like there is a lot of survivorship bias potentially in crypto if you're like doing it somewhat naively. And yeah, sometimes hard to even access the data of the delisted tickers. And there are plenty. Yeah, the landscape have changed a lot over the last 5 years, and the last two even sometime, so we focus on the tradable, liquid enough tickers, let's say top 40 market cap assets, above a certain volume filter, which would be, say, 30 million average daily. And we try to find predictive factors, or factors that have predictive power in the cross-section of that universe. Um, and then create, yeah, like a couple of simplistic backtests, and like moving towards more on the modeling side, how latency sensitive this is, how much turnover there is, how much smoothing do we need to apply. I think because we are coming from a market microstructure metrics side and focus, we do need to usually target turnover. So each of the alpha factors need to have, like if they're turning over 100% of the book every day, that won't survive transaction costs, even if I see information coefficient is zero point 0.2. But if we can slow it down in a way that the predictive power remains, which is definitely not always the case, then we have something that is a candidate for, yeah, further backtesting and further model development from that point on. So we target turnover, we scan for it.
That's a very sorry to interrupt you, but
Yes, please.
that's a very that's a very unique perspective of classification. Like you do build a cluster and from like everything that you have just mentioned, like the entire process, and that cluster itself is been totally built upon your hypothesis. So there is no like the generation of a candidate is even gets to be much strong, like much harder task to fulfill, because everything, like the process entirely is being built upon your hypothesis. Is that correct?
I mean, yes, but at the same time,
Yeah, well,
we
initially.
come up with a lot of hypotheses. So, like you could also say that there is some data binding bias in this because we are producing a lot of these hypotheses, and like we are trying to figure out what others think interesting, who are potentially traders in crypto, etc., etc. Really take inspiration from that as well. Just yeah, I don't know why I'm talking about that, but.
Mhm. No, yeah, you know what really gets me very very curious about it is like obviously, well, you do have your hypothesis that you build upon it, and then you organize a data set. And I would like, obviously, the data set is constantly changing, and like your hypothesis might be getting a bit weakening if the regime itself has completely changed, and that shifts the entire picture, and that regime shift might be a bit tricky. And I would like to ask you about like after doing that cluster, how do you know how to classify the data properly? So the cluster itself remains clean, remains clean to start a research upon it, but still would it be very naive to different market changes, and still would be very reliable to start testing upon it.
Yeah, crypto has gone through lots of different regimes in the last 5 years, right? There was this um, 2021 euphoria of retail traders that was very much driven by retail. I think you can probably still see, like a lot of retail domination slash volume in certain times. And if I am completely honest, that's when most of the alpha is in the market. That's when more alpha is most prominent and most present, and can be harvested even in the cross section with um, yeah the greatest magnitude.
Mhm,
Um, because that creates just dislocations that otherwise would not like or not that pronounced. Um, so you were asking about the different regimes. How do we make sure that like we kind of stay constant, or like these factors have constant predictive power, right? If I am
mhm. Yeah,
um,
sure.
so um,
You know what? I would like to add more to that
yeah,
question. I don't think the
please,
there is a certain relation, but you have mentioned that during 2021 there is like
yeah,
a brush of retailers going over cryptocurrencies, and for me it seems like as long as the market gets more efficient, it's obviously harder to locate alpha, but seven trading days. Not all of the market makers are active during those during the seven trading days. Well, majority of them are active, but not all of them. And still the cryptocurrency landscape on a full gets much more established, but it is still very emerging because have retail intervenience. And I would like to ask you how hard it is to locate or to detect alpha in comparison to future data. And I think that it might relate to the previous question that we would like to dive deep into. I don't know. You make the decision.
sure. I think I think it's the reason why we ended up specializing in crypto and really focusing on it is because that's where we see, like considerable alpha in compared to anything else that we have done before. I think the kind of like CAGR that you would get with an alpha factor in crypto is, yeah, substantially different if for a cross-sectional alpha factor in US equities. You wouldn't need to that means you wouldn't, because the assets are so volatile by default, you wouldn't need to use that much leverage or leverage at all depending on your goals. Um, that creates, like a completely different dynamic. You are not really relying on a small alpha being magnified into potentially a larger CAGR, but you're actually trying to downsize the risk and these really volatile assets and their contribution to um, I can talk a little bit, some interesting bits about that because that is also challenging in crypto. Um, but so I think it's just a different scale, right? We could identify sharp 1.5 alpha factors that like can be potentially even traded on their own in crypto, and then if we of course like ensemble them into a single portfolio that is multi-factor that creates even a lot better risk-adjusted returns, also smooths out the turnover and the signals that are the asset-specific signals that are um, that would negate each other and it's just if you're like a bond fund, I'm not even sure yet there are that many long short bond funds. I have zero idea what PIMCO and the others are doing, but like you're producing, let's say, 5 to 10% CAGR, right? And you would need, if you want to turn that into like a professional money management kind of system where you are managing, serious amounts, you would need 100 million to break even. While in crypto, you can do that with five potentially, because the category is just on a different scale, or maybe 10. Just
Yeah, well, I think it's going to be time that will determine that will determine the carrier issue. Um, but I would like to take that conversation even more in depth into its understanding after talking about data classification. What do you think about crypto derivatives, etc. Um, because derivatives are are sitting on top of of an asset class. And obviously, everything is being directly influenced from the asset class, and the asset class is not necessarily supposed to be correlated with the performance of derivatives. And we see it, very, very, very clear in cryptocurrencies, which is completely, not really related to what's exactly happening in the NQ and the Nasdaq. I would like to ask you, how do you or actually make if you look at the correlation in between the asset class itself to its derivatives, how do you think about that correlation? What do you think about the data? Do you like I don't know,
yeah.
find any
There-
idea from looking at the asset class? Because I do think it's a very interesting point of view looking at the asset class and its derivatives at the same time, and to determine some deterministic decisions about upon it.
yeah, I think there are very clear signs and alpha in even just observing that. So you can, of course, the derivatives and both the spot and the derivatives are really liquid for the most traded coins. So Bitcoin, Ethereum, Solana, et cetera, they will be tracking, the spot price pretty well. But if I'm honest, if you have been trading up until 2022, there has been plenty of alpha in just basis and funding rate, meaning observing that and their predictive power over the overall market and direction. So they were pretty good indications of how over-levered the whole market is. If you look at how much higher the futures were trading compared to the spot, and crypto has this very or somewhat unique, maybe less unique now as it's going mainstream, think about with perpetual futures where they never expire. So you are compensated with this constant payment that is being essentially determined based on the basis of these two. So um, So yeah, like previously, and to be honest, really thought that that still applied, but that definitely break in 2025 when you could see this the October liquidation cascade that has happened maybe over the weekend, which to be honest, we I think there was no observable sign of that if you look at basis and funding rates. Because the perpetual market didn't seem to be that over leveraged compared to previous episodes of similar crashes. That definitely happened in 2022, end of 2021, and yeah, on the in the previous cycle.
Mhm.
Um, so there is still if you are like a market maker, you would be using basis probably in your alpha model slash pricing model, as it still has predictive power over a short time horizon. But yeah, that kind of has its predictive power has shifted. Probably, I would attribute that um, to maybe more market makers and more professional market makers being present and being more successful transferring the kind of buy and sell pressure that is applied on the perpetual markets back to the spot as they arbitrage away the difference, right?
Mhm.
In the end.
Um, yeah, well, I really like the breakdown of the things that you have gone through. Um, I would like to speak about like to take another leg of the conversation, and we have spoken about regime classification and regime different market regimes, and surprisingly, before we got into the call, I was reading a paper that was published from Two Sigma. I think a while now, and they have been spoken about GMM Gaussian mixture models, which is an ensemble of distributions, about the data and to locate utility function in detecting different market regimes. Now, the problem with that approach is that you don't really have you don't necessarily have classifying certain aspect, but you do have a certain answer, but you not necessarily know how to classify it, when you really have the data. And it really makes me very intrigued by asking you about how do you like to classify you like regime changes and shifts. And we have spoken about your hypothesis, and we have spoken about how tricky it is gets to be when your hypothesis tends to break, or tend to even shift a little bit, because market are completely chaotic, and they change pretty frequently. And I would like to ask you, how do you what's your approach in doing some in building those hypotheses, because you have spoken about MCSI and Barhan, and those models. So how do you think about building an hypothesis? What do you think about when a regime is changing your hypothesis? Um, how do you orchestrate them? Initially, for what reason?
Yeah, I think we went full circle on this. Or maybe that's uh, the wrong expression. I We went from a very sophisticated approach to a more understand the market and like observe the simplest possible things and try to figure out um, whether the assumptions still apply. We Originally we started everything that we have done from a machine learning angle first, and then that was um, I think that has been proven to be way more complex, way more opaque than what we ended up with, and what's needed for the financial markets to be observed, at least when the alpha is clearly pronounced. I think right now our job is relatively simple. We kind of understand what's happening in the crypto market. We can even make qualitative decisions over what kind of factors we think are still working and not working, and why that could be the case, right? You see that there is clearly less retail activity, and you can maybe attribute certain factors not working that well to um,
Mhm.
that were really focused on quantifying and comparing retail activity to other type of market participants. You can I say that like retail will not come back? No, and we are still
Sure.
trading that. So like there is also that kind of question around whether we can predict the factor, or whether we can predict the regime, not just observe it, right? Um, but yeah, of course, they are. Although to be honest, in crypto they can change pretty fast. But still,
Yeah.
they stay for a while, right?
Mhm.
So just to give you like a clear answer, we are doing simple methods to observe the regimes. We look at the factor returns that we I think also have on our site. So it's like almost public information, or public information. We look at them, we observe them, we see that how they have behaved in the past. If there has been, like let's say a substantial drop and drawdown for a specific factor, but it usually recovers, but now it hasn't recovered. That's suspicious, right? And we can act accordingly, rather than you know 3 years ago, we would have, like a bunch of statistical tests that would do the same thing. I think we ended up dropping those because they just were very easy to mislead us and create false confidence that I think we just cannot afford to have. But of course, I'm talking about it in a context where, like the statistical sample size is relatively small, right? So how do you apply? We trade for the assets um, in our portfolio because the others are less liquid. That they won't survive. Yeah. Anyway, we would have a large market impact in the future when we manage enough. And yeah, that's 440 is not 500, right? So
Mhm.
you get.
Mhm. Um, Well, okay, portfolio managing and optimization. By the way, really like your explanation about it, but due to the time constraints, I really want
Of course.
to shift onto the
Sure.
next issue. Um, okay, spoken about a hypothesis, how you create them, and all the breakdown that you have just provided. Um, Leads you towards being able to manage 40 different assets in the same portfolio, and that portfolio is very diversified, and very very liquid. And still, the hypothesis that you have built, onto like different asset classes or different asset clusters are actually constantly changing. And I would like to ask you how it is to manage a derivative portfolio over cryptocurrency as an asset class, what you have learned over doing those for a relatively short time right now, and like what are the most important factors that you look at it um, when you're actually constructing a portfolio, and what
Mm.
are the most important factors that you look for?
Yeah. Um, I think what makes it really difficult in crypto is that the forecasting volatility and the sizing problem that creates. Um, there are It's highly non-stationary, and if you look at individual crypto coins and look at their behavior over time. Um, especially if you move away from the top 10, you will see
I
Red
guess, I guess.
Red
I was just,
Bulls. Yeah. I
I
mean,
guess I'll wait for your response.
there are these assets that like climb to the top 10, and then they're clearly a scam if you just like look into like their mechanics, their potentially their founders, and like the whole story. And even like that may be obvious just from their landing page. uh But so sometimes you don't even need to do further research, although of course you should. And then the question is, how do we capture, like the quanti how do we capture that quantitatively? How do we prepare for those to be, like considerably more volatile than the assets that have been around for a longer period of time, kind of proven themselves, maybe have meaningful revenue, which is a new thing, right, in crypto. That like even fundamental factors kind of seem to be like working and performing well, as the market has been shifting from, yeah, anyway, from the retail mania.
Mhm.
um, the difficulties are, how do you estimate future volatility, which you're dependent on, right, to size these assets? How do you uh, how do you deal with these idiosyncratic events that really affect you, even in the cross section? So,
How often those idiosyncratic events are actually happening?
yeah,
Pretty,
right.
right?
Well,
Pretty
every
frequently, right?
year a
Oh my
surprise.
gosh, you have spoken about non-stationarity, and I imagine to myself, how can you tolerate that time series towards something that would be even enough reliable to start having a proper research about it? Now, I guess we have spoken about normalization in data, and it's a completely different scale of emission for quants in a field. So yeah, I'm with you. I was just having a wonder.
Yeah, it's a learning process, right? We don't have clear answers. We are trying out everything that we can, and like trying to
Yeah,
diversify between
it's
the
like a
different
tango. It's like a
approach.
tango.
Yes.
Hey,
So
you're dancing all around.
the like a fun story is that in October, when there was like this huge drop, I think that happened over the weekend, uh, based on a certain president's tweet or whoever. I don't even remember. And then I think crypto has fallen like 10% in an hour, the whole asset class, as is. And that may, yeah, include, of course, a lot larger beta asset. Beta is definitely a thing in crypto. Um, so there, like the market makers disappeared. We had um, um, it was we were suddenly up. Like the portfolio was up, let's say 10 to 20% in a single hour. But there is this
Ooh,
huge mean reversion
oh my
effect that
God.
is going on, that, like where as like things normalized, and the market makers came back, and and the participants woke up or whatever. Um, like things started to kind of go back, and we gave back a lot of that, which is completely fine. We are not set up to kind of capitalize on these events. But of course, that also kind of creates that kind of question, like, could we have capitalized on it? Could we have been better in capturing that? Stop losses don't necessarily work that well in a cross-sectional portfolio, because then you suddenly create this tilt, right? That is completely unintentional and really hard to kind of put in a more, yeah, like predictable framework.
Mhm.
But of course, that could have worked really well for us in that specific moment. Yeah, so these are the stuff that we are dealing with. We do not have the ultimate answer, but yeah, trying out a bunch of different things and figuring out how we could, yeah. Usually, I think being market neutral helps. That's just if you don't have that, then you're a lot more exposed to all of these idiosyncratic events. Maybe to the better or for the worse. That's up to luck or skill or both.
I can't really imagine how struggling that mission gets to be when those idiosyncratic events are actually happening pretty frequently, and how it's just trash data, but very lucrative type of data that we still need to count unless we're not going to be successful like at any point without taking those into proper care, and that really makes the system and the mission itself much more complicated to execute. I would still need to dive into that type of conversation about portfolio, and you've mentioned about different volatility types of things, variational types of volatility into your portfolio that you're very raving to understand. And I guess correlation in portfolio is a very interesting thing that you are looking for constantly. And my question is how can you map the factors, uh, like extract those factors out of your portfolio, map them properly, and make wise decision on top of it. What's the most I don't know, reliable source to do it, and how you're able to actually extract the rightest data in order to make the rightest decisions on top of it as a CIO, like from a CIO perspective, looking on top of the portfolio.
Yeah. Um, so I will spend three sentences on the types of data that are available in crypto. Actually, they, I think, map to pretty much what you would get in US equities slash anywhere else. So there is sentiment that, like you could argue that it may their performance slash predictive power, even if there was any, may be degrading quite a bit as, whoever who knows what AI
Yeah, sure.
will be doing with that. There are these fundamental factors that are, like crypto or the blockchain is very unique in terms of like you can observe the transactions, you can figure out what kind of revenues these protocols are generating, and you can create, of course, cross-sectional portfolios out of that. Um, and various other types of metrics, usage, et cetera, a lot more public and lot more frequently updated or could be observed than with quarterly reports. Um, and then you get the derivatives market slash market microstructure metrics that we focus on. The like the data is. I think anything in crypto uh, is not going to be precise, and like there is like a large margin for error, uh, but that's fine as like the volatility is also large, so you're operating on a different scale. Hence, we are not extremely concerned about like missing a trade on a single asset, but yeah, because like even that the aggregates are still like creating substantial differences relative to each other on different assets. um but yeah, there are these, of course, during the idiosyncratic events, also the exchange feeds are slowing down and considerably throttled, and there is, yeah, considerable latency. You cannot trade, you cannot get the data. It's pretty big of a mess, as we have observed in October. Yeah, so I think that's the easiest answer is that yeah, it's just the errors are scaling with the with the volatility. Hence it like hence it's manageable.
Mhm.
Um,
Okay. You know, well, I'm glad that it's still manageable. Um, And I would like to shift, where I'm very, very excited to have someone who sold this company previously. And it's not a thing that's happening, every session. And let's talk about you selling your company. What was the company all about, and what was very intriguing in time in the sense of doing an exit. And yeah, now it's going to be a conversation, between entrepreneurs and not like in between quantitative researchers.
Sure. Yeah, so we were in a completely different, unrelated business. Mm, it was it was a language learning app. It is a language learning app called Drops, and it's very visual. It's very design driven. It's very playful. We have started it. It's like an overnight success, 10 years in the making. That was 10 years in the making. We started it very early in our tech career. Um, and like I wore definitely different hats throughout that process, from yeah co-founder to designer to software to CTO to chief revenue officer. We built a team of 25. It was a completely remote team. We were really proud of it. We had team members in everywhere across Europe, and yeah, we ended up kind of selling it at the right time in 2020 to Kahoot, which was kind of on a shopping spree because they have raised a lot of money from SoftBank, and they put language learning on one of their slides, and kind of think that's how random slash serendipitous these kind of things could be. That like they had a slot for a language learning company. There was kind of no one else that was, I think, comparable, and like that fitting to their brand. So they ended up making an offer, which we refused. Then they made a better offer. And yeah, we became, and everything went down really fast. They done due diligence in a month, and then it was announced, and yeah, we signed it, and everything happened. Yeah, within a very short period.
I'm very, very happy for you. Obviously I don't hear like, many quants that came from selling their company, and and think that it's like completely different, like 180 degrees completely different than the quantitative industry. And what you wouldn't say it's different?
It's different. But it's difficult as well.
Yeah,
I mean,
but
we have seen,
both of the
yeah,
tests are very, very difficult. You like taking like you like choosing roller coaster path to your to your lifestyle. So that's the type of characteristic you are.
sure. I am not sure whether that it's that conscious, but yeah, thanks. It's good to hear us pronounced like that. But yeah, I think it is difficult to, like get into quantitative finance with a different background. We had so many rejections when we were okay, like when they realized that we are not coming from prestigious, quantitative firms. We don't have the background. We got like an A immediate no. That was back in the days when we were doing quant macro. And to be honest, if I am, like crypto is really special in that sense that, we are pretty unique, that you don't have to be super experienced slash have a very traditional background in crypto to be, like if you're serious, then at some point people realize that you're serious. And
Yeah,
so
well,
that also made it easier for us.
as we've spoken before, before we started the session itself, we've spoken about like how how many quants do I know from academics background
Mhm.
are actually appearing, and apparently they're very, very excelling in field because, well, they have a slightly different background than all the prestigious STEM candidates are actually coming from. And Well, I do want to go back to the quantitative conversation because that's the point. That's the important. And I would like to ask you again about portfolio after after messing with more than a couple of different assets. And after knowing how do you extract features, I would like to understand how do you optimize your portfolio ongoingly when you have an idea, an idiosyncratic event, when you have like a a very bad performance from a type of an asset, or like how do you do those optimization procedures in order to optimize your portfolio to receive the performance that you're looking for. And by the way, congratulations for selling your company. It's very fascinating for me to see entrepreneurs that are actually sifting in between industries with with a new boss and with a new flash in their eyes and doing something new.
Yeah, cheers. Um, I have two different answers to the what do we do on the portfolio optimization level. The first one is that we don't do much. We definitely try to size the assets based on future volatility because that's really important. There is those the volatility per asset is really um, yeah, like it's really that dispersed in crypto, and there could be like 10x differences even in the top 40. Um, and um, and then the answer for the first part is why don't we do anything more sophisticated is because we don't necessarily need to, and we wanna for a certain extent we wanna capture the kind of rule alpha that is there in these cross-sectional alpha factors rather than adding anything on top of it that would potentially degrade performance or would lead to places where it would be more hurtful than less. Uh, that being said, we do have a partner who is for where we trade and who is using a lot more sophisticated optimization process that is looking at factor level performance, asset level performance, and creates an EV estimate for each of the assets and trades that and reconstructs a portfolio based on that, plus of course a volatility estimate. Um, so um, these are the two things that are currently coexist with each other. I cannot really tell you which one is better. I think we have a lot more confidence that a more of a dynamic version would perform better 2 years from now. I think right now that's maybe not the case, and it's just too much risk to take on full on.
Mhm. Um, very intriguing, answer because you have been speaking about like the entire procedure that you're taking before starting trading something like clustering, classification, and everything, and the optimization for the portfolios that tends to be you know a fraction of a process like in comparison to what you do before plugging it into the portfolio itself. And for me, it is a complete signature of the reliability of the research process. So if you're not optimizing the portfolio pretty frequently, I would like to ask you, how do you optimize your research process? How often you optimize it? Well, you led me to ask that that
Yeah,
question. It's not
sure.
me, it's you.
I um how do we optimize it? I think how are we optimizing it at the moment is that we are running to running it through a new set of yeah, queries that we have constructed, new sets of features. Um, and then we look we have automated most of the robustness tests and, like the finicky details of how we are, like that comes later in the research process. So what we are really aiming for is similar slash, like um, very easy to very consistent performance across. If for certain features, we do need to create rolling aggregates of some sort. So, like it. Um, because otherwise they are not they cannot be traded. So via
What do you mean? What do you mean by saying rolling aggregate?
mm, so let's say we have this factor that represents or quantifies retail activity compared to any other activity, and that creates like a rolling estimate. Or, like we cannot really trace that for a specific window. We do not know when a specific person has entered and exited the derivatives market. So we have like a rolling aggregate of retail activity that has to be, yeah, like we need to define a couple of different windows for that, and then we define those windows and we create these rolling aggregates that needs to be, like a very
By
smooth
the way,
kind of.
I guess that those rolling aggregates are changing in a sense of the frame that you're actually making each window. So each window has its own length, and you're actively changing the length in the window. And after changing the length in the window, then you have like pretty sustainable amount of information about the rolling aggregate. How do you actually deriving the rightest information out of it?
So I think um, conceptually it's very simple. If we find a um, if you find a feature that needs to be aggregated across time, we wanna see like the performance, the information coefficient, the simplistic long-short ratio backtest to have like a very consistent kind of performance. So, like if it may peak at a certain window size, but it should be pretty evenly distributed, right? If that gives us a lot of confidence that okay, we don't, it doesn't, the specific window doesn't matter, and we never use specific window sizes. We ensemble a lot of them at the same time and then create yeah, a rolling aggregate of aggregates of different window sizes. But yeah, it's, I want to see everything being, if it's like if it's a positive IC factor, I want to see all of the IC being on the positive side, maybe, and have a very plateauish, very normal distribution, like, or even wider thing of.
Mhm.
Otherwise, it's very easy to find
Well, yeah.
false positives.
Mhm. And going back to the process optimization that you're doing for that you're doing for not just for the features but for the research process entirely. After doing those rolling aggregates, and you have a feature that you really count on, and you have made your proper due diligence after that specific feature, how do you know drive towards with it?
Drive towards, what was the last word? Sorry.
So drive towards and like having a clear and concrete understanding of what to do with the type of the feature, with the type of the asset, with the type of whatever it needs
Yeah,
to plug into the portfolio.
sure. I mean, like we have so there are two different approaches. Previously, we were looking at correlations between the different factors later in the process. So, of course, we want to find idiosyncratic factors that are not correlated to our existing sets of factors, right? That's the main goal. You can do that in a couple of different ways, depending on where do you want to push that back into the research process. You can first neutralize the kind of returns that you are targeting. based on the well-known factors or the factors that you want to neutralize against. So you can really push that back into the very early stages of the research process because you are not just using simple returns of the assets, but the returns minus momentum or whatever you wanna
Mhm.
however you want to conceptualize neutralizing it. Um, or in the past, we were just pushing it through the initial parts of the research process, looked at the correlation matrix and, in general, how that varied over time compared to the different other factors that we already have in our catalog. And we know that they are set in stone kind of, or, they are stable. And then decide, is this worth spending more time on, or is it just like a manifestation of a different factor that we have already been trading?
Mhm. Well, it's a hell of an assembly line that you're just describing here, and I would like to ask you how what type of infrastructure in terms of software do you need in order to battle test multiple amount of different combinations to locate a candidate?
Um, I mean, honestly, not much.
Really?
You have to, yeah, I think, like
Okay.
it's enough to have pollers in place and you are probably good to go. But we build this orchestration layer where we can really parallelize the queries against the raw data that we are using very actively. We spun up hundreds of instances that are ephemeral and then create these queries, then aggregate the data. But to be honest, the research part is, I think we have just probably optimized it pretty well to be, like quite fast in the end. So yeah, that's our background, right? It was hard not to do in the end. But yeah, I mean, I think in the next generation of tools, like you can run these tests, really, really fast. It's the difficult part is creating the queries, which are, like L2 incremental updates or the book update data, et cetera, et cetera. You need to aggregate that. You need to aggregate that across all of the assets on and potentially across exchanges as well. That's the hard part. For that, you need, like 6 months of hardcore data engineering. But that's also can be done with DB pollers. We try to avoid all of the stateful databases. We have a streaming engine that creates these live.
Mhm. You know, I have a problem with you, Mark. I would have to admit that I have a problem with you. The problem is that I can continue that type of the conversation for for a very, very long time because it's very, very interesting. The conversation itself is very, very fluid. And I think that we have dived deep, not deeper, but we have dived into a layer that we can say, okay, we understand and we have clarified the points. It not happening for me at least pretty frequently that I have a guest that is speaking very, very freely about the thing that he does with the amount of confidence that you speak about like the procedure that you're taking on your end, and I would really want to thank you for sharing it and for collaborating for participating in the podcast. For me, it was a very, very very great experience listening to you and listening to your to the notes that you have shared. I have learned very much out of the conversation entirely, and fortunately, we haven't covered
No?
we haven't covered everything because it's completely not possible to do it with 72 minutes now.
Oh,
Uh, and I would love to have another session with you. And it was brilliant opportunity for me to speak to you and to dive deep into the things that you're doing. For me it was a great pleasure having you here on our show, The Blushing Quants. So thank you for your participation, and I really appreciate it.
sure. Thank you, Afak. I really appreciate the opportunity, and it was really great to chat. Thanks for
No,
the
it was
investment.
my pleasure. I told you. It was a pleasure of mine, and I really enjoyed the conversation. And And yeah, it was brilliant. So again, Mark, thank you for coming. It was a pleasure. And yeah, guys, until next
Thank
time.
you.
It was again. Um, and yeah, until next time. See you then. Again, Mark, thank you.
Thanks.